Okay, morning everyone. I think we'll kick off. It's 12 o'clock by my watch. So welcome to this panel session entitled The Paradox. Is the market as good as private equity funds believe or as bad as economists think? So we'll explore that in a little bit of detail. My name is Andrew Taylor. I'm Head of Leisure for NatWest and RBS. We're joined by a distinguished panel this morning. So I'll just introduce my colleagues. I have Peter Arnold from EY. Peter's a director in the Economic Advisory Team based in London. His role includes assisting clients to understand the impact of the economy in their businesses. We have Gabriel Peterson from Blackstone. Gabriel is MD, responsible for asset management activities and oversees the hospitality investments in Europe. He's involved with acquisitions with a focus on the hospitality sector and previously worked for Westmont and IHG. To my right, I have Cody Bradshaw of Starwood Capital. Cody's head of European hotels, where he oversees the firm's investment activities and asset management across Europe, having previously worked at Hyatt and Pebblebrook Hotel Trust. And then finally, Tim Helliwell, a fellow banker from Barclays. Tim heads the hotels team, responsibility for the UK and Western Europe. Tim's been a lender in the sector for last 15 years and headed the hotels team since 2006. So hopefully we have a good distinguished panel and a good topic, lots of food for thought. I saw HVS's recent report that there'd been a jump in transaction volumes of 86% across Europe, 40.5 billion euros of transactions, with the most active three markets being the United Kingdom, Germany and France. So hopefully we'll hear a bit more about that as we go through the session. So I think today we're approaching this as we have practitioners from the fields of equity, from debt, from economics, and they'll share their broad views based on their personal experience. And I think just to kick the debate off, I can look to Peter, and so the logical point to start with, so is the economist's view really that the market is so bad? What are your thoughts, Peter?
Well, I think ultimately it depends where you look. I don't know if any of you got up to the 8:30 session this morning, which Capital Economics did a little bit about the economy, but they've probably slightly stolen some of my thunder today. But you know, the story there was very much actually a mixed story, depending on which economies you're looking at. The market I know best is the UK, and I think it's fairly clear that the recovery has been going for a good couple of years now. 2014 was a good year. We think GDP will be about 2.6%. EY thinks 2015 will be even better, up to perhaps 3% GDP growth. Unemployment continues to fall. It's now below 6%. Employment is at record levels. And despite the rapid growth in employment and the decline in unemployment, we're not really seeing any wage demand pressure, and therefore inflation remains low. Now, clearly, the decline in the oil price recently has really helped that story. But as a consequence of the oil price decline, we were talking about interest rates rising somewhere in 2015. I think clearly the election may delay that decision, but actually the decline in oil prices is really suppressing inflation, and that could push out any increase in interest rates in the UK really into 2016. The combination of all of that good news is that probably for the first time for many years we're going to see a really big difference between the growth in real wages and inflation. So we're expecting real wages in 2015 to grow by about 3.7%, and that will really support the consumer and the consumer purchases, and I think keep the pace of recovery in the UK pretty strong. The recovery in general has been reasonably balanced. Yes, it's been driven by the consumer, but we have seen business investment pretty strong. And if you look sectorally, then all the key sectors of the economy, bar government, so services, manufacturing, construction, they're all positive, and all the marketing surveys suggest they will remain positive. But there are some downsides, clearly. There are always downsides whenever you look at an economy or you hear from an economist. The fiscal position in the UK remains incredibly challenged. It doesn't necessarily hit the headlines that you see in other parts of Europe, but it's certainly the deficits in the UK are among the largest. It's been a taxless recovery, so despite this rapid growth in employment and the decline in unemployment, that hasn't translated into higher income tax receipts, and that's therefore the fiscal position which, you know, 5 years ago Osborne was hoping by now we'd beginning to close the deficit and almost be in a budgetary balance. That's nowhere near going to be the case. We're now looking probably through to 2019, 2020 before the UK's finances get back in balance. The balance of payments is a disaster. It just keeps growing, the deficit keeps growing, and there's no real sign of an export-led recovery that we're hoping for. And there's other structural problems that we all know about the housing market. So there's still some major problems in the UK. Overall, though, we see a positive story. We think the growth that we've seen over the last couple of years still has another couple of years to run. The biggest risk, really, for the UK economy is the contrast with what's happening in Europe with the Eurozone. There we see growth, very little growth, stagnation almost, if we look across the Eurozone. There was a discussion this morning about actually the story varies quite considerably between the Eurozone member countries, and that's true. But actually overall, 2014 growth was just under 1%, 2015 again will be around 1%. And unemployment is almost double what we see in the UK or the US at over 10%. And if you look at real unemployment black spots of, say, places like Spain or Greece, it's up in the 20s, with youth unemployment even higher. And that's a real issue. And that weighs down on Eurozone demand, domestic demand, and that is a big risk to the UK economy as well. The Greek situation, I think, remains a boil that needs to be lanced. We've had another compromise. The problem has been, the can has been kicked down the road for another 4 months. But ultimately, there needs to be some resolution that is both sensible from an economics perspective, but also is one that is acceptable from a political perspective, both for the Greeks and also for the wider European communion. You have to have some sympathy with the Greeks. Their economy has shrunk by a quarter since the peak in 2007, 2008. That's the kind of reduction that we saw when the Soviet Union collapsed and the Eastern Bloc moved out of communism and started adopting more capitalistic practices. So we're talking real generational declines in the size of the economy that really hurts, and you can see why the politics has shifted so dramatically in Greece. And a solution needs to be found that I think keeps everyone happy. But as one of the questioners asked at this morning's session, Greece is only a relatively small part of the Eurozone, and there are some positive stories, particularly in the last few months we've seen coming out of the Eurozone. So the German economy performed strongly in the last quarter of 2014. The Spanish economy is doing very well, and probably the Irish economy is the real poster child for the reforms that the ECB and the Commission are recommending. They've taken great steps to improve their productivity, to increase their competitiveness, and as a consequence, GDP in Ireland is really booming again. We think last year could have grown by as much as 5%. So there are some real positives. I think the policy steps that have been taken recently, so the QE programme that's been announced in the last few months, that adds to the story. We've previously had a contrast between the European Union and perhaps the UK, the US and Japan, where the European Union has gone down the route of tight monetary policy, tight fiscal policy, and you compare that to what we see in the UK and the US, where monetary policy has been far looser, with QE starting a much longer period ago. And again, in the UK, although Osborne has talked about austerity, we've not really seen it. Actually, they've been quite loose fiscally. In Europe, it's not been the case. In the Eurozone, actually, fiscal austerity has been enforced pretty strictly, and that's really taken demand out. But we're beginning to see that, maybe not happen in practice yet, but the likes of the French have said that we're not going to follow the very, very stringent budget conditions. We are going to be a little bit more relaxed in our fiscal policy, and that will help. The decline in the oil price will also help. It's a big boost to consumers, a real reduction in the costs that they face, and we'd expect to see a big demand increase there. And finally, the decline of the euro against the dollar recently, I think that will help European exporters. So I think the answer to the question is probably how I started. It depends where you look and what you look for. I don't think it's as bad as perhaps some people think, but there's no doubt that the Eurozone remains fundamentally kind of impaired and challenged, and I think some policy action is needed to really to increase the growth trajectory.
Thank you, Peter. And I think if you look at the hotels backdrop against that, I mean, certainly in terms of the UK, we've seen continued growth in, occupancy and RevPAR. And I think what's interesting is sort of the way that in the last 12 months that's flipped around to being a provincial growth engine rather than a London growth engine. And it'll be interesting to see what 2015 does. Just following on sort of that point, we'll now sort of talk a little bit about a funding view and an equity view. Tim, would you like to give us your views from a funder's perspective?
Yeah, sure. So I guess it's very much a UK and then a European view. The UK side, and Andrew mentioned transactional volumes, and I think UK delivered about €6 billion in 2014, and with projections of the same in 2015. And I mean, it's all about confidence, really. It's confidence in UK hotel trading, where most of the commentators are, through their crystal balls, are seeing, confidence of trading for 2 to 3 years. Could be longer, but who knows? But certainly that confidence is coming through for the lenders in looking at the trading numbers of the entities that they're looking to support. Of course, there's been a huge amount of liquidity coming into the UK, and that liquidity, albeit being from slightly different sources, I sense in 2015 will still be around. And you put the positive trading, the liquidity, and the confidence, and you sense UK will be carrying on, for the next 2 to 3 years. We sense. From a lending perspective, the only word of warning I would say is that twofold. One, we seem, and I've talked about this previously, that we seem within the space of about 18 months to gone from the bottom of the lending cycle to the top of the lending cycle. I'm not talking about trading, I'm talking about lending cycles now. You could barely fund a provincial hotel in 2012, whereas in 2014, 2015, it's likely that you're going to have a sea of liquidity out for you. And certainly in terms of structures that we're seeing, it feels very close to where we were in 2007. So there is some caution. I'm sure the equity guys will talk about values and opportunities, but it feels like from the funding side of things, this lurch of liquidity has taken us through a full cycle in something less than 18 months, which is quite interesting. Europe is more of a mixed bag between the relatively resilient economies, I'll say, in Germany and France, and those which are recovering. Germany and France are perhaps, to a degree, similar to the UK. The rest feel like where the UK was in 2011, 2012, depending on which jurisdiction it is you're looking at. And I sense the equity guys can talk about that. But it still seems to be very much that they are outside funding opportunities, so outside liquidity, probably following the investors into those markets. But it's still, there is activity in the developing or recovering economies, but it seems to be very much led by the investors that are going into those spaces. So that would be my overview.
Yeah, and I suppose just to add from a funder's perspective, I suppose the thing we can't lose sight of is interest rates. And we've had a sustained period of very low interest rates. And obviously that's not going to last forever, although it does seem to be that sort of forecast of when interest rates is going to start to rise just keeps getting pushed out and pushed out. So and I think as a house, RBS is currently saying it's going to be Q2 2016 before interest rates rise, and then probably only by 0.25%. Possibly with another rise at the end of 2016, whereas I think a little while ago we were forecasting interest rates rising in August of this year, and that's sort of pushed back again. I don't know what the EY view is. Would you agree with those times?
Yeah, no, we've done exactly the same. I think 18 months ago we were probably talking about a rise, maybe end 14, early 15. That then became autumn 15, and is now. You said I think we say Q1 2016 rather than Q2, and again, but the same slow trajectory of increase. We don't see interest rates normalising back to historical levels for many years to come.
But obviously that will at some point have an effect on cost of funding. But so I suppose now I'd be really interested to get the view from the private equity side from Gabriel and Cody in terms of how they see the markets. And Gabriel, would you want to start us off?
Yeah. First of all, I'm pleased that Peter has a positive view on things, because as soon as we heard we were going to have an economist in the panel, I think Cody and I immediately called him to see what his views were, just to make sure we were not on a different page, and it would have been an interesting, perhaps a bit more fiery panel. But yes, we agree. I think overall it's positive. The UK much better than Europe. I mean, it's obvious. We see that on our assets. We see that on performance indicators and everything. But again, Europe, if one is cautious in terms of what one predicts of Europe and the projections one makes on an investment, there's still a lot of things to be done in Europe. And also some of the negatives that Peter was addressing and that we all are aware of also create opportunities. So the more difficulties a country is going through, the more opportunities is going to be to actually find deals that, with some capital investments, with some turnaround opportunities, you actually find good deals to be done. So from an investor point of view, I think things are very good in that sense. There's still a lot to be done. UK very, very strong, and I agree with I think most of the panelists that there's still probably 2 years to go of I would say high growth, high level of growth. Then it will probably stabilize, but still growing. Europe, unfortunately, that's not the case. It's actually very moderate growth. In some markets, even flat. But as I said, in those markets, there are opportunities to be done. So overall positive, and also perhaps not so positive, but the fact that there's a lot of capital chasing deals, which means that we'll have to fight very hard to find new deals. On the other hand, that's also positive, the fact that every time we sell something, there's a lot of interest in whatever we are selling. So it's, as always, it's pros and cons. But overall, I'm positive.
Sure. Well, I suppose it's anybody's guess what's going to happen over the next few years in Europe, but one simple view that we take is that interest rates are going to stay lower for longer. And if it does get worse, then interest rates will stay lower for even longer. More capital will come into real estate, searching for yield, which will create more liquidity in the market, which I think is good for all of us. You know, it's funny, when I look, because obviously we invest across multiple asset classes, and all I cover is hotels, but I see most of the investment committee decks for my colleagues that cover office and retail and logistics. And their decks are probably 80% focused on the microeconomic situation, because those asset classes have generally fixed income streams, and you're betting on the local economy. Whereas our hotel decks are probably 20% focused on the economic situation, because after all, we're opportunistic investors, and the hotel industry is both operations and real estate. And so when I present a deal to our committee, it's far less about making a prediction about the economic situation, and it's much more about how I'm going to fix this hotel. Because that's what I do, is I fix hotels. I don't predict the future for the economy. And so when I look across Europe and we decide where we want to focus our strategy, one of the first areas questions we try to answer is what is, I always ask my team this, they bring us a deal at some nice shiny hotel in a beautiful part of Europe. I said, well, tell me about the local labor laws, and tell me about my ability to flex labor to drive operating performance during a hold period. And unless you know that, you really can't go into a country with any sort of clear plan or strategy, putting aside anything related to the situation of the economics. The other interesting thing that I think has happened, which people probably aren't always aware of, is with the lower interest rate environment, the new funds that have been raised in both private equity and hedge funds have in some cases very different structure than historical years. And there's a lot of hedge funds out there that only need an 8% return before they kick into the pref. So all the partners in the funds that are working for carried interest, where they get a bigger piece of the pie, they got to clear an 8 before they start seeing more of the action. And so the cost of capital has come down significantly. Plus the resurgence in the debt markets has come down. And so all of this liquidity in the market has been fueled by both a lower cost of capital on the equity side, as well as attractive debt financing. And so you can go into these situations in these countries and achieve your return expectations at frankly lower yields than historical. But I think a good example is we've been active in the UK, and it was fourth quarter 2012 when we were under contract to buy Principal Haley, which was the first big deal we did in the UK, a platform deal. And we underwrote a 2% market RevPAR CAGR during our hold period. And a lot of people asked us, you know, there was a lot of questions of, we were kind of first out of the gate to do a deal there, and where did we get our conviction from? And we had a very comprehensive business plan on how to drive value and drive performance specifically with or without the help of a market recovery. And I think that still holds true for a lot of the opportunities that we look at in Europe. We're never going with a baseline significant CAGR growth in RevPAR or underlying economic conditions. It's all about how we're going to drive performance through a very comprehensive asset management plan, and what's our starting basis look like, and what does our exit options look like on exit. Because that's the other challenge in these markets is what is your exit plan? You go into a lot of these countries like Italy. Italy's probably one of the more interesting opportunities in the world. Fragmented, mostly unbranded local operators. But then you start looking at the list of institutional buyers that have succeeded in that market or even own real estate in that market. You can count them on one hand. And so it starts to become more of a question of ability to transact, whether or not it's an easy place to do business, and the liquidity on exit. So I think there's a lot of variables that we look at beyond the economic prediction of the situation, because clearly I'm not an economist, and that's not my profession. So,
but going back to the interest rate, we're talking about interest rate going up. I mean, Peter, you can confirm this, but first of all, you're saying that it will probably go up in a year from now or 9 months from now. And we're not saying huge percentage increases, right? We're talking about 25 pips, maybe a quarter, I mean, right? So it's not something that, okay, we'll start changing things, but it will not be a dramatic change from one quarter to the other, right? I mean, so that's also a positive, I think, right, in terms of, even when we talk about interest rates growing.
Well, our chairman who spoke earlier, Barry Sternlicht, is always quick to point out that the U.S. can't raise interest rates or it'll go broke. It's taken on all this debt to shoot itself in the foot. So other countries are going to have the same challenge.
Yeah, and I don't think you can underestimate how much support has been provided in the UK and the US through very, very low interest rates and quantitative easing to the economy. And their policymakers will be very, very careful
how to untangle that and
so they need to. It will be, say, 25 basis points at a time. Let's see what happens, and then slowly unravel monetary policy back to a kind of a norm that we expect to see.
Yeah, and I think on that, there's been a bit of a reset in recent years in the sense of the sensitivity of the regular consumer to interest rates. Whereas I think if we go back 10 years, there was a lot less consumer sensitivity to interest rates in terms of what the peak would be. Whereas now, I think if interest rates peaked at sort of 5-6%, that would put huge pressure on households. That's certainly our view. I just want to pause for a second at this point and just see if there are any questions from the audience before we carry on. Anyone's got any questions?
Sure.
Michael?
So, from what I hear, sell in London in 2015 and 16, and buy in Greece and Spain.
Well, it's interesting when you look at the owners in London. A lot of these are sovereign wealths or high net worths, and selling is a great time to sell. But then the question is, where are you going to put that capital next to achieve a similar yield?
Greece and Spain, not economic, 20% economic, cheap labor, high unemployment. You have a 7-year hold period, plenty of time for a rebound, low interest.
I think,
or maybe I'm wrong.
Yeah, I mean, I think we all. It's not a secret that we've all been trying to do deals in Southern Europe for the last year or so. Actually, you guys just signed something the other day, right? So yeah, I mean, there are opportunities there. It's not that easy to find. Sometimes the size of the platforms that would be good for funds of the size that we have, and also the quality of the assets. I mean, there's a lot of distressed assets in odd locations all over Spain, as we know. So they're very sort of granular portfolios that, for someone to go in with that, requires a lot of effort and doubts as to the time it will take for you to turn that around. But yeah, there is opportunities. I mean, we are actively looking at Greece. I'm not sure yet, but yeah.
I think the risk with Greece, if you buy now and there's a Brexit, you automatically lose 50% of the value of your investment. But I mean, actually, probably what would be really, really helpful for the Greek economy is if they did exit, a significant devaluation of the new drachma would suddenly make the tourism industry in Greece looks so much more attractive relative to the rest of the Eurozone. And so you're then tapping in demand from outside the country to come in and go to the beautiful islands and take advantage of the country and the tourism industry. And I think that's related to the point made about Italy, and actually more generally, it's interesting to understand where the demand is coming for particular hotels in particular areas, in particular subsectors. Is it driven by domestic demand? Is it driven by business travellers? Is it driven by international visitors? And I think that's probably a better indicator of the potential success of an investment than the domestic economy per se. So understanding I would say it's a bit obvious here, but understanding where the demand is coming from for that hotel. So if actually you're buying in prime London and the market is sort of travellers from the Far East, from Russia and the Middle East, then actually what happens in the rest of the UK economy is not so relevant.
But the other point is, if looking at those two countries, everything that's been covered in jurisdictional risk is far greater. You talk about the labour laws, it's about the language issues, and the comfort of the trend of investors, predominantly North American with some Middle Eastern, have got comfort in somewhere like UK. You start going further east, then the challenges in some respect become increasingly greater.
Yeah, I mean Russia, I totally get it.
And that in itself is an interesting jurisdiction.
Christian?
Yeah, I was interested in your comments, Cody, about difficulties of potentially exiting in Italy. I was wondering, given the amount of deals in the UK have been PE, real estate fund, how do people exit from the UK in good time, given the history of IPOs in the UK in the hotel sector?
Right.
Hasn't been great.
So I think that's the question of the year in the UK. Is what are all these exits going to look like? Because we've suddenly got a glut of supply in the market in terms of deals, both ones that have been announced and ones that everybody knows is coming. And I mentioned this yesterday on another panel, and private equity groups don't like to buy from other private equity groups, and yet the vast majority of owners in the UK are private equity groups at this point of these big platforms, so something's got to give. And there's a few deals coming up that are owned by private equity groups that were done at the right time 3-4 years ago. Great deal for them. They want to crystallize some of that value creation now, but there's still a great growth story left in those platforms. I think the KSL Malmaison Hotel de Vin is a great example. They have their reasons for looking for a quick exit, but that's a fantastic platform for somebody to come in and look to that's scalable on a global basis. And so I think ultimately these private equity groups across Europe are going to have to get past the historical issue of not wanting to buy from each other, because we've actually been one of the top sellers of hotels in Europe, easily top 5. And I think that's going to be a trend for other private equity groups. But beyond that, I think the real opportunity in the UK is going to be for the domestic buyer, because when you look at a lot of the NPL activity that was done, within that are large chunks of provincial assets, even a deal that we have on the market right now. So we bought 3 platforms, we've merged them together. It's a total of 60 hotels, including 50 that are owned. And we've got 19 of them on the market right now for sale. And it'll probably end up going to a domestic buyer, because these are more local, provincial properties that have a tremendous amount of opportunity left. Some of them sit on 100, 200 acres with large opportunities for alternative use and planning. And so I think a lot of these domestic buyers that have been very frustrated by the dominance of the U.S. hedge fund and private equity and the transaction volume over the last 24 months are finally going to see their chance at scooping up some good bargains of hotels that are going to take some work to drive the value, but at least they know the market's better than anyone and have that edge.
I think there was a question here.
Yeah, how concerned are you about the election and the Brexit, perhaps? Should it happen at all, the in-out referendum, if it were to happen? What effect would it have on confidence, both for banks and PE?
We'll start with an economist field.
Yeah, so I think the elections are, I think in practical terms, whoever gets in, not much will change in fiscal policy or really monetary policy. So while there will always be a natural uncertainty in the run-up to election, and then perhaps some of the announcements that the Labour Party have made are less potentially business friendly, but they've tried to rein that in a little bit more recently. So I don't think the election will do anything other than what it normally does, which is potentially delay a few decisions for a few months. But after that, I expect things to be pretty much the same regardless of who gets in. The issue of, I think, Brexit is more significant, because ultimately that's like the Scottish referendum to the power of 10, I think that will really create uncertainty in the economy and investors' minds when they're thinking about the UK as an option, and potentially also when they're thinking about the rest of the Eurozone as an option. I think there was interesting articles in the press over the weekend saying that actually probably Brexit, where that goes depends as much as what happens in Europe. So if we see a steady recovery in Europe, suddenly the kind of the economics of being in Europe look so much better than they are when we're constantly talking about crisis. And I think actually the referendum is probably in the same way that the Scottish referendum went. I think the kind of the sensible heads will, and the kind of the clear heads will probably vote to stay in. But I think certainly probably the bigger risk of the coalition winning the election, or even the Tories having an outright majority, will be that referendum suddenly comes on the table, and that will create 2 years of uncertainty.
And that's my point, because
Yeah.
with referendums you never know. And
No.
in the UK you don't have a lot of experience of referendum, so you never know.
Yeah, my ignorant view on that, being an American living in London, is our government's been a complete basket case for however many years, and yet we've applied the same quantitative easing that's resulted in 6 years of RevPAR growth, and supply has been constrained. And so I look at the UK, and again, I don't know your political situation as well as you do, but the underlying fundamentals and what you saw happen last year with, I think, unemployment dropped in the second half of last year faster than it's ever dropped before. Retail sales grew over 5%, which is one of the, I think, the top 5 highest growth rates ever. Clearly, the RevPAR has shot back. And so you're deploying all the tools necessary to revive your economy. And, understanding there's some key points on the ballot. You can look to the U.S. and see a dysfunctional government and a hotel industry that's roaring back. So that's my hope.
But you're also seeing on the funding and perhaps transactional side a desire to get transactions done by the end of this month. Worst case, sometime in April. And you also sense that whilst there'll be a lot of chat in the interim, you won't see further announcements coming through until after the summer holidays, potentially, depending on what the result is.
Yeah, but I mean,
I'd agree with that.
Peter might have a different view, but I don't think the election in the UK will have, I would say, a big impact on the hotel industry as such. In terms of real estate, yes, maybe if you are an investor in residential, there definitely, I mean, there's been some, depending who the government is, there's been some news on the weekend or something of Labour coming with a rent caps or something, but that could play a thing. But in hotels as such, I mean, I don't think a different government will actually create, a lot of changes or impact as such.
I think it'll only create sort of significant change if an environment is created where people no longer want their wealth to be in the UK. That has the potential.
I mean, okay, yeah, depends which government. Okay, we know Labour is sometimes not friendly to business in some ways or form, but I don't think they will be kind of kicking investors out of the country as such, right? I mean, there could be a bit of caution over a few months, but then, I don't see that so negative in terms of changes.
A couple of questions here, so Michael and then one behind.
My question primarily for Jody and Gabriel. As a private equity investor, you're not the operator, but you said yourself, when you look to acquire a hotel, you look to how to fix it. How do you import, or how do you impact that as an asset manager, owner, investor, but not operator?
We tell them to do it.
Well, but then they say it's the management. So most of your investments are branded hotels with pretty strong corporate management, hotel management agreements.
Yeah, but I think one of the changes over the last probably 10 years is first of all, as we know, everyone is moving towards franchise precisely to have a bit more control on the middle of the P&L, as we say. But even in those cases where there's still the long-term, old-school management contracts, I think the brands and the operating companies are now significantly more flexible in terms of how they receive and accept kind of guidance or strategic views from the owners. And in our case, we own managed hotels, we own franchise hotels, and we have a very good relationship with those brands. I mean, I'm talking about, it's not people thinking Hilton, we own many other brands as well on long-term management contracts, and we work with them, and they're very, they accept some of the ideas we bring to the table. And of course, every time one good leverage that one has is when you come up with capex. That also helps you. Well, we do this, but let's do it this way. So it usually works.
But Gab, would you say the same? I mean, you're Blackstone and Starwood Capital. I mean, if you're a relatively smaller owner, do you still sense that same trend?
Yeah, it depends what you call small. I mean, if it's just a single owner of an asset, I think, of course, you have less leverage. But as I said, if that owner is able to come up with capex, that always helps, because it's almost like you're trading rights. Okay, that's fine. Let's do this with the hotel, or let's improve this area of the hotel. But let's cut costs here. Let's run it this way, or try to do this. Also, you can have some say if you have knowledge on the revenue side. Even on that front, I think operating companies are being very flexible in terms of accepting the owner having sometimes, when the owner has capacity to do so. In our case, we do have some experts on revenue management, I think Cody as well, where we have those guys sit with the operating company, revenue managers and so forth, and actually try to implement some of those strategies on their hotels, and they accept it.
We could have an entire conference on that topic. I'll talk all day about the misalignment of interest between owners and operators, but maybe.
Yeah, to Cody and Gabriel again, a little bit on the same topic. There's a lot of capital coming in, a lot of equity coming in, so some competitions. The yields are coming down, and maybe also at some point you can elaborate a little bit on the type of yields or IRR that you're expecting to enter into a deal. If you enter into a deal today, when you're going to exit 5, 6, 7 years, whenever it is, there is a reasonable and probably increase in the yield. Interest rate may go up, and aren't you too worried that the turnaround of the assets that which is part of your business, whether it's trade value, is going to be wiped out by the yield going expectation going up?
Mm-hmm. Well, I think if you look and see where interest rates are now, which are next to zero in many places, they can go up significantly and still be below long-term averages. And so I think when we look at investments, if the interest rate does go up, 100 bips, 150 bips, I mean, look where that is versus historical averages. And so that we don't think that's a threat to our exit cap rate at that level.
Yeah, I think it's a very valid point, and it's all to do with how much can one improve operations. But one key thing to remember is that many assets that are being sold today, even today in most markets, the very low yields in some cases, some sort of capital chasing deals. But if you look at that NOI underlining that price, in I would say 80% of the markets, is still sometimes 15 or 20% below what it was at peak. So there's growth there in terms of NOI, not just but what you are going to do as a new owner and bring up new capex and reposition the asset and so forth, but there's also the intrinsic growth that will come from a normal recovery to what peak was already 8-7 years ago. So, but it's one, that's why nowadays one has to be very careful with the underwriting of each one of these deals, precisely because of what you're saying. But there's still we're still seeing opportunities in terms of that's the beauty of hotel real estate, contrary to some other real estate asset classes, that you have so many areas where to play with in terms of the investment that you can actually improve it. That's what makes it interesting. So.
Any other questions from the floor at this point? Yeah, gentlemen there.
We can get back to Italy and the potential Mr. Bradshaw was speaking about. What we see from Italy is that there is much interest in top locations and primary cities such as Milan, Rome, Venice. But you may know very well that the market has also independent operators which perform quite well. So it's always a big struggle to be in the top locations. So is there any paradox into looking for growth and potential, which is not yet expressed, and looking for top locations where the potential is already there? I mean, since 10 years, I haven't seen any big fund looking for cities where the leisure is a big component. But
Yeah.
And the international market is a big component. So
Yeah, we're big believers. I mean, if you had to put your money one place right now in Europe, given the sort of lack of visibility on economic conditions, it's going to be in the major international leisure destinations because they're not going to make another Rome or an Amsterdam or a Prague. And those cities have high barriers to entry, world-class assets and world-class destinations. And if you believe, even if you slice in half the projected growth in international arrivals into Europe, particularly from Asia, I don't know where they're going to stay when they go to these top 10 destinations. And so that's absolutely a focus of ours. There's also tends to be a high percentage of unbranded, independently owned properties in these markets, and so that's a focus of ours. Sometimes they're actually part of a larger platform or portfolio, which really is what makes Europe so interesting. Is it's incredibly fragmented. I think the U.S. is, don't quote me on it, but it's something like 80% branded, and Europe is slightly under 40%, and Italy's like 8% or something crazy like that. So therein lies a huge opportunity in Europe is a country by country consolidation play with the domestic platforms and portfolios, many of which have decent supply in these very markets. And so that's been a focus of ours. Some countries, particularly Italy, have been more difficult to gain traction. There's been some processes underway in Italy for well over a year now that don't seem to be going anywhere. We've been trying to build some momentum. We also have the ability to, because of the brands that our Chairman Barry has created with Baccarat and One, we're also take a very different view with some luxury developments in key cities like Rome and Milan, which don't generally fit within our opportunity fund, but we can look to our global investor base to find the capital that's willing to enter into a luxury hotel development in a city like Rome. But definitely, and I was going to make that point earlier, is looking past any economic predictions. When I look at Europe or even the U.S., the place where I would want to put my money over the next 5 to 10 years would be the key international gateway cities in Europe.
Okay. Any more questions, or shall we'll carry on? Okay. So I suppose the next area I wanted to explore was where we think we are in terms of the cycle. And I guess for UK and Europe, we're probably in slightly different places, as we've touched on. I'm also sort of interested to get some views on what sort of multiples we've been seeing, how sort of portfolio, versus single asset, views on what the preference is in terms of what equity is seeking. Just open that up to the panel generally. I don't know who wants to start.
Yeah.
You happy to do?
I think that to try and put a certain multiple or yield generally is very difficult. It depends on the market, the location. Even within a certain country, you can have different multiples or yields depending what the nature of the market is, what the asset type is it leisure, is it city center business. But we've seen over the last, I think, 2 years or so, multiples rising. Also helped by financing, which is starting to get to high levels. Not yet what they were at peak, but it's starting to get there. So that also helps multiples going up, and that's why we're seeing so many sales, so many markets, so many assets on the market. So I think I would struggle to say what the multiple is today. I mean, it's just really, in a hotel, you can do that maybe with office or retail, but with hotels, it's just difficult to say that. I mean, you can have two hotels that are literally across the street, and they would have different, for whatever reason, they will have a different view or multiple. But they're definitely going up.
I mean, I guess from a business cycles perspective, which is less industry specific but more general business cycle, I think it's clear that the UK has probably gone through the initial period of very rapid growth. It was very, very slow recovery. 13, 14 started accelerating. We think 15 will be good, but primarily as a consequence of the reductions in the oil price. And then post-15, it'd be much closer. You've gone over your recovery peak and down to a steadier kind of normal level of growth between 2 and 2.5%. within the Eurozone, I think the key question is, if we're out of recession, touch wood, do we then have this long period of stagnation such as was in Japan in the 90s, or do we actually able to achieve a trajectory that's closer to a long-term growth of, again, sort of 2.5%? And I think, again, the business cycle will vary by country. I think, as I said earlier, both in places like Ireland and Spain and in Germany, we're seeing quite rapid growth now. Particularly in Ireland, we're seeing a real bounce back from the troughs, and that's kind of quite common post a recession, and that may last for 2 months before we then come down to a slow, a more normal level. I think the question is really for the likes of Italy, France, maybe Portugal. I think Greece is a different situation entirely, is whether they can get out of the stagnation that they're currently in terms of the domestic economy and get back to a more normal business cycle.
I would say from a banker's perspective that the trend and the acceleration of multiples in the UK has been very interesting over the last 6 months, driven by liquidity, both debt and equity. That acceleration in yield compression has been amazing, and certainly it feels like now. Some of and Gap's point's absolutely right. It depends on what the transactions are, but attractive transactions are now at I feel, all-time highs. It feels that way. And equally, the type of leverage that you can attract into these transactions is very much led on a loan-to-value perspective, which actually, when you start turning these loan-to-values into numbers, you're getting to double-digit leverage in some cases on what are provincial deals. That to me feels like we are back to where we were in 2007. Yeah. And actually the leverage on some of these deals, which is currently being discussed on a very plausible 65 to 70% loan to value, is actually double-digit leverage, which is more than these portfolios were valued at 3 years ago. So that, to me, as far as UK is concerned, is we talk about who's the next buyer of some of these portfolios, and this must become a challenge, because everyone's looking at this and thinking, well, hold on a second, if you've been around the sector for a while, there's got to be some really incredible management investment strategies to make these things work. I mean, Europe is very much a case-by-case and a deal-by-deal basis, but UK, I think, is fascinating at the moment.
So, Tim, you're saying you're not going to finance hotels at high levels of LTV anymore?
High levels of leverage. High levels of leverage. Yeah.
Tim would love to finance at the 50% LTV and 400 over, but
yeah. But we're at that stage where there's a lot of, you've got to be, you'll be very selective on what you're doing at the moment, and you've got to be really clear on what the actual strategy and the proposal is.
I think I'd probably echo that from a funder's perspective as well, in that fact you're seeing that the multiples going up, but I'm not necessarily sure that the debt multiples are going up with that. I would say that it means that more money is coming from equity or from alternative sources. We see a lot more complex structures, a lot more long leasehold type structures, where actually the banking leverage is still at a similar level to what it has been. But the absolute multiple is driving more equity into the deal from other sources. And I guess, banks, and I can't speak for Barclays, but I guess banks generally still have, a memory of what they've got in their distress books. The cause of which was largely over leverage when the economy took a downturn. I'm sure, Tim, you must have the same situation as RBS. But
I would say that some of the larger transactions, the ability to attract, senior and junior debt into these deals means that you are leveraged, and I'm not seeing the need for investors to be putting additional equity in yet to justify what is a compressed yield. They're finding the liquidity to achieve the deals. So, not on everything, but that's some of what we're seeing.
About the sort of portfolio versus single asset view, from a private equity perspective, are you guys really looking for portfolios, or do you consider single assets, or does it depend sort of how prime that asset is and where it is? What are thoughts around that?
Well, one thing is clear: we're all under pressure to do bigger deals because we've raised mega funds, and so and in some cases haven't adjusted our staffing accordingly. So we have to be a lot more efficient about how we go after acquisition opportunities. The UK has clearly been a phenomenal environment over the last few years with the domestic platforms that particularly the people that have been in the industry locally for decades have been waiting to see this great consolidation opportunity. Unfortunately, I think that was disrupted by too many people showing up with the same idea, and so we've kind of taken 1 or 2 steps towards consolidating, but yet now we're fragmented again, and nobody knows how this is going to play out. But we definitely have sort of fallen in love with the opportunity through the European platform approach, because as soon as you get that first platform in any country, it creates such a competitive advantage for you to then go buy the next platform or to bolt on single assets, because you're actually able to underwrite economics that your competitors aren't. So when we bought Principal Haley, it certainly put us in pole position to acquire 2 additional platforms and essentially knowingly outbid the market because of our ability to underwrite significant synergies, starting with headquarter consolidation and going all the way down to procurement, technology, contract services, you name it. And then we've gone on to bolt on several single assets onto that portfolio, again, by looking at an asset that could be performing reasonably well in its market, but perhaps we own another hotel in that market and have the ability to complex the 2 operations to then be more thoughtful in how we're positioning both from a pricing standpoint in the market. And so we're big fans of that. And so as it relates to single assets, if it is a single asset, it needs to be a nice, big, chunky single asset in one of these destinations that we've talked about. Because I honestly, I get yelled at if we bring a deal that's less than a $50 million equity check, even if it's a great deal. So that's just sort of the nature of the game right now with the amount of capital that's flooded into these real estate funds.
And that's your challenge, I presume. You go to the Italian market and you've got all of these fragmented owners. I mean, how do even if you've got the platform in Italy, you've got 100 conversations to try and achieve the quantum that you need.
Yes.
And you've got Blackstone breathing down you.
Yeah. And also time, right? I mean, how long it will take you in a place like Italy to actually, unless if you buy a platform, to consolidate by just going to single owners. And we have a 5-year, kind of 5-6 year turn of the money. So that's the challenge.
I'll just see if there's any more questions from the audience at this point. No more? Okay. So the last couple of things I want to sort of cover off. I mean, first of all, we touched on quantitative easing earlier. I mean, do you think that has any implications for the hotel market or not?
Well, I mean, I guess the objective of it is to try and increase liquidity in the market and make it easier for firms and individuals to borrow to get money circulating. So to the extent that funding is a challenge in the hotel industry in certain parts of Europe, then QE should assist with that. I'm probably less qualified to talk about whether that is a need in practice and what's been seen in funding markets. Now, the related impact will be you hope you start getting an improvement in demand, in domestic demand, and firms start investing in new production facilities, consumers start spending again, and the economy starts picking up, and we see the kind of the recovery that we've seen in the UK and the US. So that's the kind of the secondary impact potentially as your domestic market improves. But the initial impact should be really around liquidity.
And I guess that will vary from country to country as well, as we've touched on. Okay. And bringing this to a close, I mean, the last question I'd sort of just like to pose to the panel to get all of your views on is just around lessons learned. So I mean, clearly, the last 5 years, 6 years have been quite interesting. We've seen quite a lot of distress in certain places. We've seen sort of quite a lot of recovery now. We're now talking about leverage rising, yields falling. It's kind of what are the lessons that we've learned from that period, and what do we think that we might do differently this time around, this cycle? And maybe start with Tim on that one. You were smiling.
So I guess having been funding hotels for about 15 years, I think you've got to, in my view, you've got to finance hotels through the cycle. So you've got to you're never going to know where you are exactly, but you've got to take a view on where you think a sustainable cash flow is. And when things do start getting a bit heated, I think frankly, as we say in the UK, you've got to stick to your knitting in terms of what you know, and frankly, what has served you relatively well over history. And I think history is a great indicator in this space. I think you will stay close to your key relationships, and you will stay close to hopefully the knowledge base in terms of how you've seen these portfolios and assets trade over history. And there's always going to be opportunities, and there's always going to be the right deals to do. And the great thing about this sector is that every single deal is different. This is not like funding some office. Every single opportunity is and every single portfolio opportunity is different. So there will always be good deals to do, but you have to you've got to stick close to what you know and what you believe works. Obviously, over the course of the last few years, there's been an influx of liquidity coming into the sector, and many of these institutions have got different drivers. I mean, we're fundamentally we're a corporate bank, and we want to. We're a long-term supporter of the sector. That means we've got to take a view in terms of what is sensible structures through the cycle. So that would be my key lesson that I've learned.
I suppose sort of my viewpoint from a funder's perspective also would be it's going to be about sort of people deciding whether or not they're going to stick to their principles in terms of what is pushing a deal too far and what isn't. And I think in previous economic cycles we've seen those corporate memories get quite short. In part that'll depend on how long the cycle ends up being, and I don't think we have a sense of that yet. But that sort of corporate memory piece I think does come into play.
It's funny that it's a good question for me because I've been in Europe for just under 5 years, and so I've learned a lot of lessons since I've been in Europe. It's a fascinating place to do business. I think my biggest takeaway, and this is how I approach any deal that we look at in Europe going forward, is to remember that first and foremost that this is an operating business with a real estate component. And so you really have to start and understand the implications of that on each market. An example would be if you had opportunity to buy a factory with 400 workers in France, you would immediately have some concerns about serving as employer of that factory in France. Well, buying a 500-room hotel in France that has 400 employees is really no different. And so understanding the risks that come from a social standpoint, regulatory standpoint, a tax standpoint in these countries is very, very important because you can often find that you're taking one step forward and 2 steps back. And there's a significant risk of cost inflation, even if the top line growth is positive. Because if you actually look at the long-term trends, if you get that 2% RevPAR growth, it's not going to be enough to overcome the cost inflation in these markets. We sold Louvre Hotels on Friday. We completed that sale to Jingjing, and they'll do very well with it as that economy comes back, and they've got a new balance sheet to grow that across Europe, and that was in an older fund, so we didn't even have the capital to grow the prototypes, and so we were kind of stuck in that from an expansion standpoint. So we had to focus on the other levers that we had, which were driving operating efficiency at the property level, rolling out a labor management system, rolling out a new food and beverage concept, revenue management distribution, restructuring corporate overhead. And I spent the last 4 years doing that, and we took literally tens of millions of euros of cost out of the business while actually keeping RevPAR positive throughout the entire recession through the new tactics that we used on distribution and pricing. So we took over 20 million euros of labor out of this business because we own 300 of the hotels, and ultimately during that time period, EBITDA stayed flat. Because during that time period, our poor little budget hotels in the countryside were unionized. The government increased the VAT twice. They increased the social charges, energy rates, everything, yada, yada, and it was just death by 1,000 cuts. And so that was a big lesson for me as I look where to invest in Europe, because there's a lot of really inspiring places, many that I've never even visited yet, that look like wonderful places to own a hotel. But you really got to approach it that you're buying a factory with 400 workers and how that's going to work out for you in the end.
Interesting.
Yeah.
Your closing?
Yeah, I mean, what I would add to everything that has been said on this point is I think timing. Usually there's an underestimation of how long it will take to do a certain particular. Cody was getting into all the labor changes that one needs to make on an investment. It tends to, particularly huge difference between America and the UK towards the rest of Europe. It's quite likely that in Europe, in most jurisdictions, it will take you longer to implement those changes than what you thought on day one. So I think that's a lesson learned that we, all of us, now add an extra, 6 months or a year to actually finalize those changes.
Peter, any closing thoughts or any sort of forecasts around how long you think this cycle might be?
Well, I mean, I'll do kind of lessons learned, if that's okay. I think the last 5 years, I think, is what we've certainly at EY have pulled out of things, and I think probably the economists have more generally, is that macroeconomics only tells you so much. To really understand how what performance is going to be like, you need to drill down into sector and then drill down into subsector and potentially go even further there, because actually there's been quite a number of interesting stories in all different sectors about companies or industries that have done really well during a recession. We talked about some of the advantages in the hotel industry of pinpointing specific places where you're taking advantage of international demand. Certainly in the UK, in the early part of a recession, people stopped travelling abroad, and we saw a real uptick in demand for domestic holiday destinations. And so actually the recession was almost positive. If you're a hotelier in Cornwall or Wales, then you saw quite a big boost in numbers. And that story was true in other sectors as well. I mean, one of my favourites is in Spain. Apparently, chicken farmers did really well at the expense of beef farmers. People traded away from beef and got cheaper meat from chicken. So those types of stories, when you really drill down into sectors, are quite interesting, and that can really help you get the extra insight about what the opportunities are. In terms of looking forward, I think the other thing that probably the last 10 years has taught us, or maybe 7 or 8, is that there probably isn't anytime soon going to be a nice stable economic environment where everything is growing steadily at sort of 2 to 3% and the whole world's happy and singing. I think there's enough geopolitical risk out there that there will be increased uncertainty, and there's enough hangover from the financial crisis that this is going to take a generation, I think, before we really ever see a kind of a normality that perhaps we were used to.
Thank you. Well, on that note, I shall bring the session to a close. Hopefully that's been very insightful in terms of both the economic side, the funding side and the private equity side, and thank you all for your attention.